Before I bring Michael Cox up here to introduce our speaker, the O'Neill Center for Global Markets and Freedom, which sponsors today's conference, wouldn't be here without the generous support of our alumnus out in California, Bill O'Neill. Bill, would you please stand up and be welcomed by this crowd? Thank you. Bill owes a lot to SMU. He got his education here, met his wife here. She wouldn't live in Dallas, so they moved back to LA, where she was from, and he launched his career out in sunny California. But Bill, we appreciate all you've done for the O'Neill Center over the years. Thank you. And now I want Michael Cox, who is the director of the O'Neill Center, to come forward to introduce our speaker. Michael?
And Bill, I want to thank you too. My life is so much more pleasant and enjoyable right now, and full of passion for what I do compared to what I did former being the chief economist at the Fed here. That was great, but I'll tell you, this is beyond my wildest dreams, so thank you for making that possible for me and for us here. You know, I'm not a huge fan of Jesse Jackson, but he said something one time which was just, I think he intended it as a criticism, but it turned out to be brilliant. He said, "Capitalism without capital is just an ism." And that's true. In fact, I'm going to talk about capitalism for just a second here by way of introduction. How many of you have seen the movie Other People's Money with Danny DeVito? If you haven't seen that movie, that is about the best movie I've ever seen. In the middle there at the board of directors meeting, for giving you a feeling of what the role of the corporate liquidator is and the capitalist there. So it's a great movie. But now that term, other people's money, I bet none of you know where that came from. Well, I'm going to read you just a couple of quotes here from my favorite economist ever, and it's not John Maynard Keynes. It is Joseph Schumpeter. Quote, "Capitalism is that form of private property economy in which innovations are carried out by means of borrowed money. Therefore, we shall date capitalism back as far as the element of credit creation. Credit creation is the monetary complement to innovation. Risk-bearing is no part of the entrepreneurial function. It is the capitalist who bears the risk. The entrepreneur does so only to the extent he loses other people's money." So that's where it came from, right there, other people's money. Now, we have one of those other people right here with Warren, but in most cases he didn't lose his money. In fact, he made a great deal of money by providing middle-level businesses with the funds, or small businesses with the funds that they need and appreciate to grow. One of those businesses was Walmart. And they provided Walmart. Stevens Inc. in Little Rock, which is the largest off-Wall Street brokerage firm in the country, provided Walmart the seed capital they needed to expand. That turned out pretty good. And so did many of other of the companies that they helped finance. Now, I got to talk to some of these people last week at a fantastic conference that Warren put on in Little Rock called the Stevens Center Street Conference. And there were, like I said, about 75 CEOs there from mid-level companies all over America. Very interesting companies that are have brilliant concepts, many of them, and they're much needed in America. And many of those were ones that Stevens Inc. had invested in. So that was really, I got an insight into what's on the mindsets of these people today. And it's going to mean a lot to me. Thank you, Warren, for inviting me there. But let me just conclude here by saying I'm from Little Rock. Warren's from Little Rock. Our families knew each other. My dad, Ed Cox, not the Ed Cox of Cox School of Business, but Ed Cox of Barks Root Beer in Little Rock, knew Jack and Whit Stevens. They've all now passed on, but they knew each other, and I got to hear a lot of stories about the magnificent Stevens Inc. growing up. So I'm very proud to have Warren here today. And you've got his package in your seat there. And for all of my students, this is going to be on your test next week. Okay. Warren, please do us an honor. Thank you so much for being here.
Michael, thank you very much for that introduction. It's an honor to be here at SMU and at the O'Neill Center, and appreciate all the great work you and your team can continue to do. Michael left a little thing out about his time in Little Rock. Was after he got his PhD, he came to Stevens and applied. And we didn't know what to do with a PhD economist, so we didn't hire him, and that was our loss. But it's the world's gain on that. But Michael, it's great to be here. I want to talk a little bit. Michael mentioned Walmart and our role in taking them public, which was in 1970. And Walmart's IPO in 1970 raised a total of about $4.4 million. If you'd invested if you'd have bought 100 shares in that IPO in 1970, that'd be about $1,650 you'd have had to put up. It'd be worth over $10 million today. But I was fortunate enough in the late 80s, early 90s to spend some time in Europe, going back and forth. I never lived there, but we were doing some things in Europe. And when I came back, I was talking to my dad about my experience, our experiences over there, and he said, well, you know, what do you think? And I was really struck by what an advantage the United States had in its capital markets compared to Europe. We had the deepest, broadest markets, the most flexible markets that could accommodate anybody. I mean, from the venture capitalist all the way up to the largest traditional corporation, there was a source of funds for them that they knew they could go to and access money to try to pursue their opportunities that they saw. And we at Stevens, you know, when you go back, you look at a photo album, and this just happened to me, it's fresh on my mind. I looked at a photo album, I was about 18 years ago, a little neighborhood get-together we had, and I went in there and I looked at myself and I said, how did I get so damn old? You know, my kids were this high, and sometimes things happen and you're not really aware of what's going on. And I think that's happened to a lot of us in the securities industry, and it's had a real negative impact on capital formation in this country. And so, I see some of you looking ahead, and that's okay. I do it all the time. But you know, investment bankers you got to have a slideshow or a book, or you're just not an investment banker. So I'm going to ask y'all to kind of follow along on this. So the first page, well, it's page 2. After you turn the page, these are recent SEC regulations beginning in 2001. It ends in 2011 with Dodd-Frank. This is by no means a comprehensive list. There's actually a lot more. I wrote an op-ed in the Wall Street Journal about regulation not too long ago, and one of my own compliance people called me up and said, "You're so right. You know, they're just burying us in regulation." And she was the person in charge of implementing all the rules, and I said, "Okay." She said she had a spreadsheet of it. I said, "Well, send me the spreadsheet." She said, "Okay, I'll be glad to." 6 pages. 6 pages. That's not Dodd-Frank, because we don't even know what's in most of Dodd-Frank yet. So what I want to focus on are 5 issues, and they're not all new regulations. Some of them are changes in regulations, or just changes in the way we do business. We're going to focus on decimalization and best execution in 2001, Sarbanes-Oxley, one of my all-time hated things, in 2002, the global settlement, 2003, that's actually number 1 on my most hated list, and the elimination of the uptick rule on short selling in 2007. Now, all of these things were sold as regulations or changes to help the individual investor. And I want to focus on the outcomes. Now, this is not an academic study, okay? I can't go say, well, this is exactly why this happened. But these are actual numbers, and these are facts, and it's pretty interesting. So on page 4, on January 9, 2001, the New York Stock Exchange completed its transition to decimalization. I got that word out, that was good. So we went from quoting stocks in fractions, an eighth mainly, sometimes a 16th, occasionally a quarter, to pennies. And so you went from having the typical spread of 1/8, 12.5 cents, down to somewhere in the neighborhood of 1, 2, 3, 4, 5 cents. Regulators claim this shift would benefit investors by reducing spreads and commissions. And so what happened? Firms invested hundreds of millions of dollars into building high-tech automated trading platforms. Now this is very important because it's going to tie back in later. And spreads have indeed gone down, but volatility has increased dramatically. So on the next page, those of you that hadn't seen it, this is a comparison of Russell 2000 daily returns for the 8 years before and after decimalization. and it shows that volatility has increased pretty dramatically following the transition. There are 360 fewer days with what we define as modest volatility, down 0.1% to up 1%, down 1% to up 1%. There are 285 more high volatility days on the upside, which means greater than 1% swings, all the way up to greater than 4% swings. And there's 75 more high volatility down days. And the number of daily swings greater than 2% has increased 97% from 125 to 246 days over that time frame. So on the next page, we wanted to put a little case study. We said it's IBM. I have no idea what IBM's shares were trading for in 1990, but we wanted to have a name there. So this is a transaction that would have occurred in 1990 on any $20 stock, where institution B is buying, we called it IBM, at 20 from institution A. There's a 12.5% commission, so institution A receives $19.88. So fast forward to today in 2011, if you have 3% volatility, the commission is down from 12.5 cents to 4 cents. So you have a savings there of 8.5 cents. But if you have 3% volatility on either side, on either a buying or selling of that particular trade, you could have a swing as great as 60 to 68 cents. Now, at 12.5 cents in 1990, we as an industry used that money to support salesmen, traders, and research. Well, at 4 cents, there's just clearly not enough money to go around. It's pretty difficult to do. In conjunction with decimalization, the SEC started a movement called best execution. So even though the SEC has never defined what best execution is, mutual funds and money managers have to make monthly electronic disclosures of basic information concerning their cost of execution. Significant fines and penalties are imposed on fund managers failing to provide best execution. And institutional accounts must now seek out the market maker with the most favorable bid or ask price. Now, the 12.5 cents, going back to the example in 1990, the way investors, mutual funds, money managers compensated investment banks for their research ideas was in the commission. That's the way they did that. If we took someone and gave them the idea to buy J.B. Hunt or Dillard's or American Freightways, and they liked it, they paid us by giving us that order and through the commission. Now you can't do that. That is absolutely prohibited. And today at our firm, 65% of our commission dollars come in the form of a check. It's about 25% comes in the form of a check, and the other 40% comes in commissions in names that we don't follow in research and have no connection with whatsoever. So the regulators confused cost of execution with a quality execution and a quality idea. And as a result, trading volume is dominated by firms that don't cover the stocks. So on page 8, this is an actual slide when we make a presentation to a company to get hired on an equity offering. The companies at the top, whose names we've taken out, company 1 through company 12, they're real companies. This is a real industry. And if you go down, the highlighted orange is Stevens Inc. You can see Stevens Inc. covers all 12 of those companies listed above, yet we rank 10th in the market-making activity of all of those companies. And of the top market makers listed above us, 9 firms there, only 1 firm covers 1 company. You remember we said decimalization, and we've invested millions of dollars, hundreds of millions of dollars in the trading platforms, and you can go on down the list below us. You got to go all the way down to the next to last company to have one that covers 8 companies of the 12 listed above on a research basis. What's this mean? What it means is we've separated execution from the knowledge of an industry and the knowledge of a company. I assure you, I'm not picking on any of the companies listed above us, but there's no one at Goldman Sachs that knows one thing about those companies. They can't talk to us, they can't talk to an institutional investor, they can't talk to a retail investor, they can't communicate why you should own it, why you shouldn't own it. You know, it's an interesting result of a well-intended policy. So what's been the outcome? And I'm not going to, the next page on page 9, Goldman Sachs is a great firm. There may be somebody here from Goldman Sachs, and we think the world of them. They've been successful for a long time. But from 1999 to 2009, their trading and principal business has gone from 43% of their company revenues to 76% in 2009. Investment banking revenues have dropped from 33% to 11% of Goldman Sachs revenues in 2009. Why don't we have any more information than 2009? Goldman changed the way they reported their income, so you can't get it. And if I had 11% of my income in investment banking fees and I was supposed to be an investment bank, I'd probably change the way I reported my income too. That's not a criticism. That's just what they ought to do. But there's that 76%. Now guess what the Volcker rule has drawn a bead on? That 76% right there is what they're going to go after. Don't forget, Goldman is now a commercial bank. You know, they converted to being a commercial bank in the panic in 2009. So this is going right at them, and probably Morgan Stanley and probably every other major investment bank still standing. So on page 10, Sarbanes-Oxley was enacted in July 30th of 2002. The goal, it was a result of an accounting scandal at Enron and WorldCom, and the goal was to improve investor confidence regarding the veracity of corporate financial statements. It was estimated that the cost of complying with Sarbanes-Oxley after year 1 would be somewhere in the neighborhood of a couple $100,000. The reality is it's more like $2.5 million every year going to comply with Sarbanes-Oxley. Now there is one little bit of Dodd-Frank that is good that we know of, and that is that if you're a non-accelerated filer, you would be permanently exempt from the auditor requirements that are in Section 404 of Sarbanes-Oxley. That's the only good thing that I can find in Dodd-Frank so far. But so we underestimated the cost of complying with Sarbanes-Oxley, and on the next page, on page 11, this is very troubling when you talk about a 71% drop in IPOs 50 million and below in the 5 years predating Sarbanes-Oxley and the 5 years after Sarbanes-Oxley. A 57% drop in IPOs 50 to 100 million. Now that's not total market cap, that's the dollars being raised in that transaction. The actual numbers on the 50 million and less, we had a drop of 545 offerings pre-Sarbanes-Oxley to a total of 158 in the 5 years after that. And actually, you know, you have a decrease even all the way through every category, including the 500 million and above. The hassle of being a public company has been ratcheted up much more dramatically than anyone intended. And people just frankly aren't doing it. Now, I do want to point out on the bottom of this page, the 5 years before Sarbanes-Oxley and the 5 years after encompasses July 31st, 97 through June 30 of 02 on the 5 years before. So you got the tech bubble coming in at the end of that, but then you get a bust in the early 2000s in the marketplace. But then it picks up again in 2002 with that same downward pressure, but by 2007 you've got a pretty robust market again. So where are the offerings? They're just not there. On the next page, on page 12, so where do companies go? A lot of them just turn to private equity, but a lot of them turn to foreign markets. In the 6 years before Sarbanes-Oxley, only 5 U.S. companies went to do an initial public offering on a foreign exchange. And in the 6 years following Sarbanes-Oxley, 65 U.S. companies had an IPO on a foreign market. $15.2 billion of capital was raised by U.S. companies on foreign markets. On the next page, page 13, total listings on U.S. exchanges started declining in 1998, but from 2002 to 2010, we've had a 24% decrease. And on the chart below, we've had a 50% reduction in new U.S. listings as a percentage of all listings around the globe. You know, that goes straight to the competitiveness of our capital markets. I'm no big fan of antitrust laws in the Justice Department. So instead of letting NASDAQ compete to buy the New York Stock Exchange, now we have the New York Stock Exchange owned by the German exchange, because we didn't want to have what? We didn't want to have the NASDAQ. We didn't want to have a strong U.S. Yeah, I can't figure that out. So, you know, not having competitive markets, not having and having the regulation that we have is very hurtful. So in 2003, on the next page, the global settlement. We at Stevens liken this to standing on the street and watching a 10-car pileup, and when the police come, they put us in handcuffs and they take us down to the police station. 10 firms listed here paid $1.4 billion in fines, primarily because they were slanting their research to get investment banking, corporate finance business. Okay, punish them. The rest of us weren't doing that. But this global settlement was being driven by then New York Attorney General Eliot Spitzer. It was clearly being done for political reasons. He had no concern about what he was going to do to the securities industry. It was all about his political future. And he used an obscure law on the New York books called the Martin Act, which you're actually going to see again in the coming months and years as they pursue some of these foreign exchange lawsuits against the banks, to force this settlement on these 10 firms and to pay these fines. Well, the SEC then adopted them. For the rest of the industry, those of us that were just kind of standing there on the street corner, well, we get to comply with all of this stuff too. And what did it do? It significantly changed research compensation. We as a firm get the vast majority of our revenues through our investment banking corporate finance arm. We've always used that, up until this, we've always used that to reward our other employees, some research analysts, for their role in helping the firm be successful. That is expressly forbidden now. And so you're limited, remember the 12.5 cents to the 4 cents? So you're limited now, not just 12.5 cents to 4 cents, you're limited to 4 cents and nothing. You can't get any more money to them, and it's very difficult to attract and retain very high quality research people to perform the research functions at this firm. We've been able to do it. It's been difficult. Our people have restructured their businesses on the sales and trading side and the research side a couple of times in order to continue to provide these functions. But to show you how silly it is, research analysts, the third bullet point up from the bottom, restrictions on interactions between investment banking and research. Their security cards can't open the doors to each other's departments. And if we have meetings between research and corporate finance, we have to have, in almost all cases, we have to have one of our in-house counsel present at the meeting. And in the rules, they use this word that it is a chaperone to make sure that there's no improper interaction or discussion between the research and the corporate finance department. Now, the Sarbanes-Oxley and the global settlement, these are things that were done in order to make people do the right thing. And you're just never going to pass laws or regulations to make people do the right thing. I mean, what we'd say in Little Rock is probably the same thing you say in Dallas or wherever you're from, is, if they're doing the wrong thing, they just weren't raised right, and there's not a lot you can do about that. But passing a rule or a regulation to try to make people do the right thing is just never going to work. So we did this global settlement. So what's the result of that? Turn to the next page, and we like to describe this as a flight from regulation. This is from 1993 to 2011, the number of hedge funds created each and every year. They're not subject to best execution. They're not subject to global settlement. They're not subject to any of the silly rules that we have. And, oh, by the way, a research analyst can go over here and get paid whatever he wants and have up to a 20% carried interest in the profits of that firm. Guess what happened? Surprise, surprise, research analysts and corporate finance people have left in droves and started these firms, and they've been very, very successful. There's just, again, this isn't an academic study, okay? But these are actual numbers, and these are the things we did to ourselves that have had a significant impact on our business. So the information, the knowledge of companies and industries, instead of being in an investment bank and open to mutual funds and retail investors, is now concentrated in hedge funds where you got to have a pretty significant minimum net worth to even get in the door. How are we doing on all this transparency stuff? Are we doing good? These are things that we felt had happened to our industry, but until I was invited to speak down here, we'd really never taken the time to go back and pull numbers together and see what they look like. It's pretty darn disturbing. So, continuing on with our wonderful enlightened regulation, in 2007, the SEC eliminated what's known as the uptick rule. Well, the uptick rule simply means if you're shorting a stock, you got to short it when it trades up You can't short it when it trades down. It was put in the 1930s to prevent what were referred to then as bear raids. So if you get a stock and you sell 1 million shares and it goes down, you can't sell another 1 million shares short, and you can't just make it a self-fulfilling prophecy by driving the thing into the ground. Pretty good rule, it sounds like to me. Unbeknownst to me and to many of us in the industry until 2008 and 2009, when during the panic they reinstated the rule, I was amazed they'd even taken the rule out. I didn't know that. I just missed that. So what happened? What's happened since we've taken the uptick rule out? So on the next page, again, going to volatility. This is 4 years before the uptick rule was taken out, 4 years after the uptick rule was taken out. 259 fewer days of modest volatility, defined as down 1% or up 1%. 239 more days of increased volatility on the upside and the downside. The actual numbers are stunning if you look at this chart. So 3 to 4% upside moves. There were 14 in the 4 years after the uptick rule was eliminated. There were zero in the 4 years prior. And the down 2 to down 3%, there was one down 2 to 3% day in the 4 years prior to the elimination of the uptick rule. There have been 50 since then. Now, who really wants to have your money in a market that moves around 2, 3, 4%, and you pick up the phone and you call your, hopefully Stevens broker, to get your advice, and he says, you say, well, what's the market moving? Why is it up so much? Why is it down so much? I don't know. I don't have a clue. That's not really what you want to hear. Who wants to hear that? So as a result, I think you're going to see a continued exodus of people wanting to be in the equity markets. So you remember the great investment in trading platforms that I mentioned early on page 18? We've seen the rise of what's called high-frequency traders. They're trading massive amounts, basically on algorithms and computers. They make about 10 cents on 100 shares traded. In 1980, high-frequency traders in 2003 accounted for 20% of the daily trading volume. It peaked in 2009 at over 60%. It has remained over 50% since then. Some people have other studies where that number is as high as 70%. And this is done by computer-to-computer exchange trading. Remember the flash crash? Remember the flash crash? We dropped 500 or 600 points in a matter of minutes and recovered in a matter of minutes. It was all triggered by somebody put an order in. Instead of selling 1 million shares, I think it was AT&T, they put in an order to sell 1 billion shares of AT&T. And instead of having a specialist or a human being or someone near there that could look at that and go, he doesn't mean sell 1 billion shares of AT&T. He ain't got 1 billion shares of AT&T. He means 1 million shares. Get him on the phone. And it went, algorithms kicked off. Next thing you know, we're looking at a complete whipsaw in the marketplace. And if you weren't looking at your screen, you missed it. It happened, it was over, it came right back up, and I missed it. I was doing something else. Somebody said, what'd you make of the flash crash today? I said, what are you talking about? I said, I watched the market almost all day. He said, well, in this period of time, it dropped 500, it recovered 500. Oh, good. That's great. That's what we want to hear. So, along that line, on the next page, on page 19, in 1991, it took 742 days to turn over the market cap of the New York Stock Exchange. So, 2 years, call it. 2008, we don't have numbers beyond that. 2008, we're down to 135 days. We're changing over the market, the entire market capitalization of the New York Stock Exchange, we're changing it over twice a year. So instead of having long-term investors, we now have short-term traders. And we as an industry have have let it happen. You know, it's one of these things that they nick you and you're working on your own business, you don't really think about it. And then you look at where we are today and people want to know why there's no growth, why there's no you know, well, we've cut off capital. We've cut off small companies and growth companies from the public marketplace. Now, private equity can fill some of that gap, but it's at least 75% more expensive, at least in the returns they're looking for. So you can't really replace it with the private equity firms and their capital. So on page 20, you know, kind of highlighting all the things we've done to ourselves. Decimalization was supposed to help narrow spreads. Daily swings of 2% increased from 125 to 246. Best execution was supposed to reduce costs to mutual funds. Now we have 60 cents of potential volatility to save 8 cents on commission. Sarbanes-Oxley was supposed to improve corporate transparency. Does anybody here think corporate statements are better today than they were 10 years ago or 15 years ago? It's a joke. They're terrible. I don't understand that, but anyway. SACS, you know, we've had 71% reduction in small IPOs and an increase in U.S. listings abroad. Global settlement was supposed to help police conflicts of interest. That's a joke. Hedge funds starts have increased from 117 to 364 a year. Elimination of the uptick rule has increased daily swings of 2% or more from 5 to 166. Again, this isn't, my academic friends are going, well, this isn't an academic study. You're right, it's not, but never mind, it's a fact. These are facts. Now, what all the causes of it are, I don't know, but I know these are certainly at least, they're probably almost all responsible for some of these trends. And we have high frequency trading now accounting for at least 50% of the daily volume in the markets. Okay, so I've complained about all the things we've done to ourselves. And so what would I do about that if I could do something about it? If I could do something about it, I'd undo decimalization. That's impossible. There's no way. I don't think you can do that. That genie's out of the bottle. Just forget it. But we can eliminate best execution. We can let institutions determine what a fair commission is based on the value that a firm provided them in giving them that idea, or bringing the idea to them, or even making them aware of the opportunity. So I think you can do away with best execution. You can eliminate Sarbanes-Oxley. Everyone who did something wrong in the Enron and WorldCom frauds were prosecuted under laws that existed before Sarbanes-Oxley. We don't need new laws to prosecute them. And you know, it's happened in our firm. It may have happened in y'all's businesses. I hope it hadn't. If somebody's going to steal from you, they're going to steal from you for a while. If somebody's going to cook the books, particularly a CFO and a CEO, and they all get together, they can do it for a long period of time, but eventually they're going to get caught and they're going to pay the penalty. So, I'd do away with Sarbanes-Oxley. I would reinstate the uptick, what's called the uptick rule. There are a couple of problems I didn't even talk about here. They're pretty technical. At least the naked short selling problem is. But when you sell shares short, you're supposed to have to go borrow those shares, because if the dean sells me shares short, I want my shares. I don't care that he's selling them short. So he's got to go borrow them and deliver them to me. That's a rule. That's a SEC rule. That rule is not being enforced. People are shorting shares that they do not have, and they're not delivering. And we see it in companies that we follow. We've complained and complained and complained to the regulators, and we get nowhere with that. These are the restrict or eliminate leveraged ETFs. Those are exchange-traded funds. I think exchange-traded funds have a great role in some of our investing, but when you get exchange-traded funds that are double and triple they're supposed to mimic up and down movements in an industry or a market times 2 or times 3. That exacerbates volatility. Just think about that. I mean, if you look at the prospectus of one of these ETFs that's a double or triple levered, you ought to really look at it. You'll never buy one, because Lord, if you stay flat, I can't remember what it was. Brett, do you remember what it was? You lose about 6 to 10% depending on how long, because they're having to churn that money to try to keep up. We will not let our private client people at Stephens sell double and triple levered ETFs. That's a bad idea. I don't know who came up with that, but that's bad. And now we get to wonderful Dodd-Frank. It's on the drawing board. I don't know if y'all saw this. It was in the Wall Street Journal yesterday, and we just put this in. But the government experts expect U.S. institutions, mostly banks, to spend 6.3 million hours to comply with the Volcker Rule. 1,000 man-years. There's got to be a better way, and there is a better way. Dodd-Frank was passed for a problem that doesn't exist. It wasn't lack of regulation that caused the 08-09 crisis. It was the fact that over 20 or 25 years we've had a housing policy that created 27 million subprime mortgages in this country that were packaged and sold to individual investors and institutions. That's a direct result of all kinds of housing programs and policies over Republican and Democratic administrations, and it made no sense. So Dodd-Frank doesn't make any sense either. It's addressing a problem that doesn't need addressing. I've been guilty. I told our guys when we got all this together, I said, you know, I've been real bad about this. I haven't been raising my hand. I haven't been screaming, pounding on the table, talking to my elected officials. Art Laffer was at our conference the other day, and he said, unfortunately, economics and regulation is political. You know, nobody wants to get in the political arena these days. I sure don't. But we are going to be pounding on the table, trying to make people understand we have done serious damage to capital formation and economic growth in this country. I hope you all will do the same. I know people here at the O'Neill Center will be doing that as well. Thank you all for having me here.
Well, Warren tried to apologize a couple of times for not having a scientific study with theoreticians having looked for it, but you know, it reminds me of a quote, and I leaned over to Alan and said this from Abe Lincoln, that practice proves more than theory. And it does. So we're going to take some questions here for about 5 minutes. We'll stay on schedule and let Warren answer a couple of questions. Anybody? Back there, yes, Gerald, is that you? Okay, you've got a light behind you there.
Yeah. Along the lines of your theme of being a little bit involved in your own business while things are happening, in your business there used to be a something called a self-regulatory organization called the National Association of Security Dealers, which was essentially owned by the security dealers, and they elected the board. And then that association came in and said, we'd like you not to own us, we'd like to perpetuate ourselves and name our own board, and not let you have input as to how we operate, essentially, at the organizational control level. I think that happened about 3 to 4 years ago. Our firm certainly voted against it, but 70% of the industry voted for it. First of all, did you see that as a problem? Did you vote for it? And what have you seen in practice as a result? And what do you think is going to happen in the future?
Well, for those of you that don't know, there used to be the NASD's regulatory arm was comprised of people in the industry, and we had district conduct committees and a national business conduct committee that reviewed all disciplinary cases against NASD members. I was actually chairman of District 5 Conduct Committee. I was chairman of the NASD District 5 and was chairman of the District Conduct Committee. You know, the reason 70% of Well, Kurt, I'm gonna probably get us in a lot of trouble when I say this, but you know, there is a real split between firms our size and the big firms. You know, we view the regulatory issues one way. Well, you know, at the global settlement, we're screaming about it, and they got their hands caught in the cookie jar, and so the SIFMA or SIA, whichever it was at the time, says, y'all sit down, shut up, and be quiet, because we got to do this. And my own view is we did a great job in the old structure of regulating the industry. I know my fellow committee members, it's been years since I do that. We spent a lot of time on it. We had a lot of cases. We knew what we were looking at. You know, when they come and lay these cases in front of you, if you didn't have any securities background, you would be lost. And we would plow through those things, and if we got to a point where we were convinced someone had done something wrong, to protect our own firms and our own industry, we would hammer them. Hammer them. I mean, no mercy. People barred out of the industry, you know, doing stuff they shouldn't have done. I didn't think we needed to change that. But that is another thing we are never going to get back in control of. It's too bad. But I wish we did. Another question or?
Let's take one more. Bruce, you had a question? Was that it? Okay.
You had mentioned a statement about people are exiting the equity markets. Could you follow up a little bit more on that? Is there a precipitous point at which everybody makes a run for the exits, or is this a case that at some point it will bounce in a new point?
Well, we didn't really look at the flow of funds in and out of mutual funds from over this same time frame. It's our impression from talking to our business people, our private client group, people that invest with us, is they're very sick of watching markets bounce up and down 2% and 3% and having and we have no answer. And I think I know there's been an outflow of money from the equity funds, but I don't know that number, and that'd be something we really ought to look at. We could have done for this, but this was. There's a young man over here named Brett Jackson who did all the work on this thing, and he did a great job. I want to thank him for that.